Welcome back to Investing Talk Podcast.
Today we're looking at Astera Labs. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've gathered quite a bit of research here. And, well, the core investment thesis for Astera Labs seems pretty crystal clear.
Okay.
This company is essentially a pure play, a high-octane picks and shovels provider for this whole AI and cloud infrastructure boom we're seeing.
Right, the underlying plumbing.
Exactly. They provide that crucial connectivity that data centers need to run super fast. And this position, well, it's giving them really robust growth. And you see exceptionally high conviction among the analysts covering them.
Yeah, and when you look at the numbers, that conviction makes a lot of sense. I mean, the top line growth is just... it's staggering. Q2 2025 revenue, it hit $191.9 million. That's what, a remarkable 150% year-over-year jump?
Yeah, 150%. And the bulk of that, like you said, driven by their core stuff. The Aries PCIe retimers specifically.
Okay.
Right, and this is where, we should probably pause for a second.
Yeah.
Because it's not just any growth. It's high-quality, profitable growth.
Profitable already.
Yes, they've made that transition quite nicely. TTM net income, trailing 12 months, that's over $100 million now.
Yeah.
But the number that really screams competitive advantage to me is their gross margin.
Oh, yeah. What's that looking
It's
like?
sitting around 76%.
76. Wow. That's incredible for a semiconductor company, isn't it?
It really is.
Usually you think, commoditization, pricing pressure. How are they holding on to margins that high?
Well, that margin, I think, is the clearest sign of their competitive moat. They're not just selling basic commodity chips, right?
Right.
They dominate this really specialized niche semiconductor connectivity that manages data flow within servers and between servers, specifically for AI and cloud setups. And that 76% margin, it's possible because their IP, their intellectual property, these proprietary mixed signal products, they're essential and, frankly, hard to just swap out.
So the customer isn't just buying a component off the shelf. They're buying this highly optimized piece of infrastructure that makes sure data gets where it needs to go, like error-free and at top speed.
Exactly right. And the key things driving this right now are those Aries PCIe retimers you mentioned.
Can you maybe explain those a bit more? Retimers.
Sure. So imagine a data signal traveling down a long cable inside a huge data center, like a phone call getting fuzzy over distance, right? That signal degrades.
Okay, yeah.
Retimers act like high-speed amplifiers. They essentially grab that signal, clean it up, boost it so it can travel further and faster without errors.
Got it. So as AI models get bigger, demand more data, more transfer, Astera Labs becomes sort of indispensable for performance.
That's the idea, precisely. And their moat isn't just the hardware. It's reinforced by their Cosmos software platform.
Ah, the software angle.
Yeah. This lets the hyperscalers, the big cloud companies, manage and optimize thousands of these connectivity bits across their whole network. It makes it more of a managed solution, not just a, piece of silicon.
And crucially, they're looking ahead, too. The research points to their leadership in PCIe 6.0 connectivity. So if you're trying to look ahead, say, 2-3 years, why is leading in PCIe 6.0 such a big deal?
Because it's basically setting the next speed limit for data centers. PCIe 6.0, it essentially doubles the data transfer rate compared to the last generation, 5.0.
Doubles it.
Doubles it. So data center architects, they need these PCIe 6.0 components now to design the next wave of high-performance AI systems. By leading here, Astera Labs is positioning itself as the key enabler for anyone building, say, a next-gen GPU cluster or accelerator farm. They're kind of future-proofing their revenue.
That makes perfect sense. Okay, so you've got the financials looking strong, explosive growth, a clear tech edge. Let's maybe switch gears and talk sentiment, because the market, Wall Street, they're definitely paying attention.
Oh, absolutely.
We've seen a flurry of activity lately, right? Firms like Stifel, Barclays, they're reaffirming buy ratings. I think Stifel even bumped its price target, was it $174 to $185?
That's right, $185. And that renewed bullishness, it really got cemented back in August with the Q2 results.
Ah, the earnings beat.
Yeah, they really blew past expectations. Posted earnings per share of, what was it, $1.44 versus the consensus estimate of CRII 33.
Big beat.
Huge beat. And that kind of surprise, it really gives analysts confidence that, hey, maybe the demand for AI infrastructure is even stronger than we thought.
Yeah, I saw the consensus rating is currently strong by 16 recommendations backing that up, and importantly, 0 sell ratings.
Hmm.
That kind of unanimous agreement is pretty rare, especially for a high-growth tech name like this. But let me ask the skeptical question here.
Go for it.
Given the massive run the stocks had and the valuation, which I know we'll get to, doesn't that unanimous strong buy itself become a bit of a risk? I mean, aren't they basically pricing in perfection forever?
That is an excellent point. And we absolutely have to hold that thought because it ties directly into the valuation risk later.
Okay.
The market's rewarding them now, for sure, for their unique spot. But yeah, it creates immense pressure. Right now, the expectation is perfection. Any hint of a slowdown, any margin dip, and you can see a very quick repricing.
Understood. Okay, so let's look at the chart, the technical picture right now, late October. Stocks around $165. Seems like it's consolidating a bit.
Yeah, exactly. It's trading below its 50-day moving average, which signals that short-term pullback. But crucially, it's still way, way above its 200-day average.
So the long-term trend is still up.
Right. The structural uptrend looks very much intact despite this consolidation phase. But what's really standing out for maybe more tactical traders right now is the RSI.
The relative strength index.
Yep, the 14-day RSI. It's sitting really low, around 20.72.
And for listeners, low means.
Generally, an RSI below 30 suggests a stock is technically oversold.
Meaning the recent dip might have been overdone?
Technically speaking, yes. It suggests the selling pressure might be exhausted and buyers could step back in soon, pushing the stock back up. It's a technical signal, separate from the long-term story, that could attract some short-term buyers looking for a bounce.
Okay, interesting. So fundamentally strong AI play. Technically looking maybe oversold, ripe for a potential short-term bounce. Let's look ahead then, the next 3 months or so. What are the key things that could really move this stock?
Well, the big one, the main event near term, is definitely the Q3 2025 earnings release. That's scheduled for November 12th.
Okay, expectations must be high after Q2.
Extremely high. Everyone will be watching for continued strong year-over-year growth, sequential growth too. If they meet or, ideally beat consensus again, that's immediate validation for those high analyst price targets.
Right. And beyond just the headline numbers for Q3, what about new products? I keep seeing mentions of Leo CXL smart controllers in the reports.
Yes, Leo CXL. That's a really key future driver.
That's slated for rollout around December 22nd, right?
Yeah.
Probably need to unpack this. What exactly is CXL, and why is this Leo launch so critical for their revenue mix, say, beyond 2025?
Okay, yeah. CXL stands for Compute Express Link. Think of it as the next step in how CPUs, GPUs, and importantly, memory all talk to each other inside the server.
Okay.
Right now, memory is usually tied very tightly to a specific CPU. This creates bottlenecks, especially with these huge data-hungry AI models. CXL is this new open standard that allows memory to be pooled together and shared dynamically across the whole server rack.
Ah, so you can use memory more efficiently.
Dramatically more efficiently.
Yeah.
It improves resource utilization massively.
Yeah.
Basically solves a fundamental bottleneck we have in AI infrastructure today.
And Astra's Leo controllers enable this?
Exactly. The Leo CXL smart controllers are what allows servers to adopt this new pooled shared memory architecture. So Astera Labs is trying to position itself not just as the company that fixes signal integrity, with Aries,
Right, they were timers.
but also as an architect of this next generation of computing, what they call disaggregated computing. Analysts are watching the Leo rollout so closely because it represents the next big potential revenue stream.
So if Leo takes off,
If Leo gains traction, it diversifies their revenue away from just relying on the Aries retimers. And that diversification, that new growth engine, that's what could potentially justify the really high valuation long term.
got it. That really is the narrative driver then. What about institutional activity? Anything coming up there?
Absolutely. You've got two key dates to watch for institutional flows. First is December 15th. That's the semi-annual ETF rebalancing.
Where passive funds adjust holdings.
Right. And then early January 2026, around the 5th, we get the 13F filings.
Okay, remind us quickly, 13Fs.
Sure. 13Fs are required reports filed quarterly with the SEC by large institutional investors, basically anyone managing over $100 million.
Yeah.
They have to disclose what stocks they bought and sold in the previous quarter.
So we see what the big money was doing.
It's exactly. The filing around January 5th will show us which big hedge funds or mutual funds were buying Astera Labs during Q3. Seeing conviction from those major players, well, it often drives significant trading volume and can influence the price as others follow.
Okay. And lastly, there's always the market chatter, right? The speculation around these high flyers.
Oh yeah, there's plenty of that. Persistent rumors of M&A. You know, could Astera Labs get acquired by a big semiconductor player like Intel or Broadcom? Or maybe even a hyperscaler itself like an Amazon or a Google?
Just rumors, of course.
Just rumors, absolutely. But, the logic isn't crazy. Astera Labs controls key tech that a bigger company might want to lock down for their AI supply chain. Plus, there's also market chatter about them potentially landing another new massive hyperscale customer contract. Multi-year deal. Big numbers.
Again, treat with caution.
Definitely. But in a momentum-driven market, these kinds of rumors absolutely can pour fuel on the fire.
Okay, so a lot of positives. Now we have to do the responsible thing and talk about the counter-argument. We've painted a pretty compelling picture, but the risks here, they feel proportional to that upside potential.
They absolutely are.
We have to address the elephant in the room, valuation.
That's right. Risk factor number one, by far, is the valuation. The price-to-earnings ratio. Well, it's extremely high, sitting at almost 275.
Wow! 275.
Yeah. So when you're looking at a PE like that, we're not just talking premium. We're talking about pricing in near perfection and truly explosive growth for years into the future.
Which makes the stock incredibly sensitive, right?
Incredibly sensitive. Any hint that say, 150% year-over-year growth might slow down even to something still really impressive like 100% or 80%, that could trigger a really violent contraction in the multiple. It's the definition of a high beta stock. Very sensitive to news.
So what does that 275 PE really demand from the company?
It demands, well, first, continued extraordinary execution on their current products, the Aries line. But crucially, it also demands that the new product lines, like Leo CXL, start contributing meaningful high-margin revenue almost immediately upon launch.
So if they miss on Q3 earnings, or maybe even if their guidance for Q4 sounds a bit cautious,
the street could punish the stock pretty brutally. Because that premium isn't based on current earnings, it's built entirely on that future exponential growth story.
Okay. What about customer concentration? You mentioned the hyperscalers. How big a risk is that?
It's a significant risk. Our sources show that, their revenue relies very heavily on just a few massive cloud and AI customers. The big guys.
Classic concentration risk.
Exactly. So if one of those giants decides, hey, maybe we can build some of this connectivity stuff ourselves, vertically integrate, or if they shift their spending plans towards a different architecture from a competitor, Astera Labs could face sudden significant revenue volatility. They really are, to some extent, at the mercy of the spending cycles of maybe 3 or 4 incredibly powerful global customers.
And tying back to the Leo CXL launch execution risk must be huge there too, launching brand new tech into critical systems.
Absolutely enormous pressure.
Yeah.
Flawless execution is basically required, especially for something complex like Leo CXL going into mission-critical data center infrastructure.
Right.
And remember, they're a fabless company too. They design the chips, but they outsource the actual manufacturing.
So they depend on partners like TSMC.
Exactly. Which means they're still exposed to potential hiccups or constraints in that global semiconductor supply chain. They need their manufacturing partners to scale up reliably and quickly to meet all that potential demand.
Okay, let's try and pull all this together then. Synthesize the overall outlook for someone listening. The big picture seems to be Astera Labs is, kind of undeniably, a leader in a really critical high-growth niche, that AI connectivity infrastructure piece. They've got the impressive margins, they seem to have a solid technology moat, and even the technical chart, with that low RSI, suggests a potential rebound could be on the cards.
Yeah, I think our overall bullish rating, weighing everything, comes in around an 8.5 out of 10. It's a very high conviction idea, and it's a big gay.
Yeah.
But you absolutely have to be able to stomach the potential volatility.
Right.
Stock actually looks pretty interesting across different time horizons, Tactical traders, maybe they look at those near-term catalysts, Q3 earnings, that oversold RSI, perhaps aiming for resistance levels back up around $190, maybe $200.
And for the investor with a longer view, structural investor.
Well, for them, this stock offers pretty pure play structural exposure to the whole AI growth megatrend. There just aren't many other companies offering that with this kind of focus. You're essentially betting that their leadership in CXL and PCIe 6.0 solidifies their dominance in data center architecture for years, maybe generations to come.
But that rich valuation, that PE of 275, that's the critical caveat hanging over everything.
It absolutely is.
Which means that Q3 execution, and maybe even more importantly, the guidance they give for Q4, it's not just important, it's absolutely paramount for keeping the stock's trajectory going.
I think the real question for investors looking beyond the next quarter is this. Can that expected big shift in the revenue mix,
Yeah.
getting significant contribution from new products like Leo CXL, can that genuinely justify this current premium valuation, even if Q3 earnings do impress? Ultimately, it's a bet on that long-term evolution, not just the next 3 months.